All right. Okay, well, I'm going to go ahead and get started, and then Candace, you can just let people in as they pop in, since it is now 2:04. So thank you so much, everyone, for joining us today. We are so excited to welcome back Phil Blancato. He is the president and CEO of Ladenburg Asset Management. Phil is a 32-year veteran of the financial services industry and has been a frequent guest on CNBC, Fox Business, Bloomberg, and many more. We want this to be very interactive for all of our clients that are joining us today. So please chime in, unmute yourself, interrupt, raise the hand on the little comment section, and just let us know any comments or questions you have along the way. So Phil, there is so much conflicting information going around. We've been telling our clients to expect a slow start to a recovery for 2022. The news keeps saying we are on the verge of a recession, but the market has been exploding upward year to date. So what can we expect for the rest of the year with everything we are seeing in the market and the economy? And can you explain what the Magnificent Seven is? And is that going to help us the rest of 2023?
That's a great, all wonderful questions in there. And I'll start with the easy one. What's happened so far year to date? Much to everyone's surprise, including mine, I thought the market would return about 15% this year. And that's really where we're at right now, just between 15 and 16%, depending on the day. And the reason why the market's done so well, it goes back to the end of your question, the Magnificent Seven. And reality is, I'll call it the top 10 stocks in the S&P, but even if you want to keep it to the seven, it's Netflix, it's Apple, it's Salesforce, it's Google, it's Alphabet, and it's, I'm forgetting the last one, Amazon. So when you think about those names, they're the ones that have driven for example, they are today represent 90% return of the S&P 500. If you push it out to the top 10, it's 95%. The top 20 stocks is 100% of the return. That means 480 stocks in the S&P 500 either flat or down on the year. So it's a very good probability that if you don't own some of those names, you're not making any money this year. This is called a very narrow market, when a handful of names are the reason for the market to push significantly higher. And narrow markets are very dangerous because first you get some FOMO. Did I miss out on a huge opportunity and why am I not in the market? And second, you get the scenario where as fast as they go up, they can come back down. And the reason why is when just a few names are responsible for the return, those few names, a modest correction could send them spiraling back the other way. Now, in fairness to these names, if we compare 2001 to 2023, which is a similar paradigms. Remember the tech bubble of 2001, we had a bunch of internet stocks that had tremendous excitement behind them, really explode the market higher. And then 2002 came and they all got wiped out. And the reason why they got wiped out is because they didn't make any money. There was still this potential to make money down the road. Remember Netscape? And you think about all those names and what they were, some of them survived. And the reason why they survived, specifically in Apple or Microsoft, is because they make money now. And truth be told, these big companies represent the bulk of the revenue of the S&P 500 as well. Today, Microsoft is a $3 trillion company. Apple is a $3 trillion company. NVIDIA, that's the other name I forgot, is now a $3 trillion company. So when you look at these companies, they are drivers of the economy. And what happened in 2022 was when the market sold off terribly hard. And we saw the NASDAQ just get absolutely beat up, which is NASDAQ is traditionally tech stocks. There's a little dirty secret about tech stocks, and I'll explain this. And if I make it too complicated, please tell me. There's two types of companies you can buy. You can buy Caterpillar, a value company that pays a big dividend and grows based on the revenue it makes every year. Or you can buy, I'll use Apple as an example. It's less so today than it used to be. I'll use Apple. Apple is based on not on the money it makes today, but its future expectations of money it's going to make. And that's because they come out with new products that are pretty cool and people want to buy them. And the expectations they're going to continue to come out with new products that are pretty cool and people are going to want to buy them. So, for example, Apple's had this tremendous run this year, not because of the American consumer, but because of, just for fun, let me see if anybody knows, why has Apple had so much success this year? What country is driving the potential for Apple to be significantly higher? Anybody know? What's the second most populous country in the world right now? And actually in the next month will become the #1 most populated country in the world.
India.
India today represents only 6% of Apple's sales. Their cell phone market is expected to increase tenfold over the next few years. They're putting in tremendous infrastructure and beginning to really grow that country up. They will pass China in GDP, and there's a threat that will even take us over someday, and that's probably 50 years from now, but no time soon. Apple, the potential for the consumer in India is driving Apple shares so much higher. So here's the difference. Caterpillar, brick and mortar company, chugging along, doing the same thing every day, making a little bit more money each year. Apple, the potential to make it go higher is what made it go higher. Now, here's the dirty secret I was talking about. When interest rates are going higher, growth companies like Apple tend to borrow a lot of money because they're always creating and building something new. They're trying to grow. And when rates are higher, it's more expensive to borrow money. Think of yourself as a retiree who's not spending a lot of money. You don't need to grow any. You don't need to borrow any money to do things. But if you're in your 30s and you're just getting going, you're growing your family, you're growing your life, you got to take on debt. You got to go out and buy a house. You got to go buy a car. The higher the interest rates are, the less you're going to grow. That's the same thing in the stock market. A value company, an old timer, an older person who's retired, doesn't need to borrow money. They don't care about interest rates. A younger person, a growth company, a growing person, cares a lot about interest rates. So when interest rates go higher, growth companies tend to get punished because they borrow money more expensively. And that's the dirty secret. So in 2022, all those growth companies got clobbered. And now what's happened is the market said, hold on, things are different this time. Apple is a great company. It makes a lot of money. Because it's sold off so hard, we should be buying it. Microsoft is a really great company and makes a lot of money. We should be buying it. And the same thing for, well, Netflix changed their model a bit and helped them quite a bit. But the same thing for NVIDIA. Artificial intelligence was just an afterthought last year. Now it's the potential of what it might grow to become. So even in spite of higher interest rates, those magnificent seven have rebounded. One, because they're good companies. Two, because they got oversold last year. And three, because the potential to be the drivers of the U.S. and global economy for years to come. So to answer your question, what got us here was just a handful of stocks. To some degree, justifiable. Not totally. Because right today that they've grown too far too fast. But my worry is that they could reverse and go the other way quite quickly. So that's the long answer to your short question. And the other piece to your question, as far as the economy and the mixed data, there's two things at play here. We hear recession. And the reason why we hear that word time and time again is because when companies or people have to borrow money to grow, it's very expensive. Think about if you went to get a mortgage today, it'd be a 7% mortgage versus where it was 2 years ago, where it was a 3% mortgage. So it costs you double the amount of interest payments right now. When you increase the cost in the system, banks lend less money and people borrow less money, which slows down growth and tends to lead to a recession. That's why the federal government keeps hiking interest rates. And the byproduct of doing that is inflation comes down. So that was the narrative. But oddly enough, there's a belief, and if you remember from the last time we met, for those of you who were at the event, I'm in the camp that I think the Federal Reserve has done a great job. They've done a very admirable job of getting us out of the pandemic and not putting us into a bad recession, keeping the economy afloat and keeping it going on a pretty steady path. Getting interest rates higher, but at the same time getting inflation lower. Things have worked out pretty well. In fact, right now, wages are higher than the rate of inflation. So for all the talk about recession, and a really nasty one, just hasn't happened so far. It still could. I still think it's going to be a mild one, because we can get into that in a second. But the reason why I think it's a mild one is when you look at what the economy is today, it's fine. Things are not bad out there. Inflation has come down significantly. No, don't get me wrong. Jam is still up 16% pre-pandemic. Cereal, 16% pre-pandemic. Yogurt, 15% pre-pandemic. So there's still some things you buy that are more expensive. But gas certainly isn't more expensive. Lumber is not more expensive. Bricks and mortar and concrete, not more expensive. Some things are back to or lower than pre-pandemic. Some things are not. Airline travel, more expensive. Hotels, more expensive. Things service related, they're still more expensive. So the Federal Reserve is not done yet. And that's the reason why you get this mixed signaling. Fed keeps hiking interest rates. They're probably going to do it 2 more times. More of a concern of a recession. So far, it hasn't borne any fruit. So some folks saying like me, mild recession because everybody's got a job. They got a big wage increase. They haven't gotten overloaded in debt. They're going to be just fine. Or the other folks say, no, there's a lag effect to all this costs in the system that the Federal Reserve has done. And that lag effect is going to play itself out. We're going to have a very deep recession soon. It's going to hurt everybody. Let me stop there. That's a really long answer to a really short question, by the way. I'm sorry. Go ahead, Kyle.
Oh, it looks like you were muted. Let me jump in. First of all, I just wanted to share how much we enjoy your podcast, Phil, and how you've got a very wonderful way of taking the complicated things we hear and to clear away the clutter of the media and make it simple and give us direction. We appreciate that. In working with clients nowadays, when we're looking on the interest rate side, we see rates highest after about 1 year. Could you talk a little bit about that? About how do we reset our sights to 3 and 5 years out when rates look so much higher just over the short term?
Hey, what the federal government has tried to do is slow you down from buying stuff. You're buying too much stuff. You're having too much fun. You're traveling too much. You're jumping on boats. Carnival Cruise Lines is booked out 2 years. You're jumping on planes. You're going to hotels. Europe is having one of the greatest travel seasons it's ever had. So right now, demand is too high. Why is demand high? Because you saved $2.7 trillion during the pandemic, and you've got $800 billion left. You've increased your credit card debt, but your home is worth more than it's ever been. Your job is paying you more than it ever has. Your Social Security check is up 10% from pre-pandemic. So everyone's got more money. So it's okay. Well, a little bit higher debt, who cares? So what the federal government's trying to do is slow you down from buying stuff. And to do that, they hiked interest rates and they keep hiking them and hiking them. But here's part of the problem. The bulk of the wealth in the country is people over the age of 65. Some of those folks are on this call. And you all in pretty darn good shape. Your home is worth more. You have a lot of money in savings. Stock market's been great the last 10 years. Heck, it's great this year. You made up for quite a bit of the losses of last year. Not all of it, but quite a bit. You're traveling, you're having fun. You probably would love a good recession. Why? Because you've already got money. So a good recession would make things cheaper. Who knows? That would keep us actually humming. Actually, that's the reason why I think we have a very mild recession, is because the baby boomer today is in good shape. So to your question of interest rates, how high do they have to go to slow down demand? How long do they have to be there? Well, truth be told, the reason why I think there's only 2 more hikes in the federal government is because we're seeing inflation come down on a fairly decent pace, not rapid. But remember, a year and a month ago, inflation was 10%. Tomorrow, we're going to get the latest headline data on inflation. So headline inflation is probably going to be below 4%. It means you've taken 6% out of it. Now, a lot of it is because of energy has come down quite a bit. A lot of the goods have come down quite a bit. Well, we still have this high service inflation. That means inflation has gotten to a point where it's come down, but the last mile, going from 4% to 2%, it's going to take some time. So they go higher means you got to leave rates higher for longer, slow down demand that much longer, probably see some pressure in the labor market. Finally, we're seeing some pressure in the labor market. The number of open jobs was almost 12 million a year ago, now down below 10 million, about 9.8 million. We're seeing the number of people getting a job per month go from about 500,000 a month to about 200,000 a month. So the labor market is finally showing some signs of weakness. And the reason why that matters is inflation for wages will start to come down as well. So to answer your question, Dave, you probably look at higher interest rates for at least another 12 months. But you'll see the slow grind down. And in fact, what happened this year, because inflation still stayed stubbornly high, we look at something called core inflation. So if you take out the cost of food and you take out the cost of energy and look at just the other stuff you buy, that's still stuck at about 5%. It doesn't want to come down. And that's where your demand is. All that stuff you want to go and do for fun. And that's going to take some time to unwind. That's probably going to take another 12 months. That means interest rates and inflation will come down together in lockstep, but it'll take at least another 12 months to get us back to something where we were pre-pandemic. And I don't think we get back to 2% inflation, one if ever, but 2% probably pre-pandemic will take at least another 18 months. It could happen faster if we get a really deep recession where there's a lot of layoffs. So far, that doesn't seem to be the scenario. We have very open job, whereas for every one person looking for a job, there's 1.6 open jobs. So there's more jobs open, there are people looking. And that's been that way for quite a long time. So I would expect rates to be higher for longer, but slowly come down.
Thank you.
Rock?
So I was trying to tell everybody, hey, if you have questions, just chime in. The problem was I couldn't hit the mute wasn't allowing me, but I think Candace has released that now. So if any of y'all have questions, I mean, hopefully we got it. And so if somebody has a question, please feel free to chime in. We got Phil right here. I mean, he's got a pulse of the market. So ask away.
You can even type, if you don't want to speak, you want to type it in the chat box at the bottom, that's cool too. If not, I can give a couple other pointers on where we are in the market as well.
Well, let me just ask you this while somebody's thinking about it or whatever. So you're talking about traveling. My wife and I, we just did our anniversary trip. We went out to Charleston, South Carolina. Well, we flew into Atlanta and we tried to get something to eat at the airport. First off, the United Club was closed at 7:45 in the evening. Don't understand. They said staffing. Then we went over to St. Arnold Brewery restaurant over there. The kitchen was closed at 7 o'clock in the evening. Okay, we couldn't get food. They kept saying, "Oh, we're understaffed. We're understaffed." The excuse that is going on about all the airline debacle that happened week before last was that, oh, the rainstorms and then being short staffed. But yet, when we look at unemployment, it's saying that, oh, there's not that many people unemployed out there. So why are there so many jobs that are available and so few people?
So it's probably the most challenging economic question we are faced with today. One of the things that has kept the United States in the pole position, being the biggest economies in the world, is that we have a really good demographic makeup. Every year we grow our population a little bit. Well, we had a double hit against that in 2021 and 2022. It was the first time in modern era that the U.S. population shrank because, unfortunately, because of people passing away at a basically double the rate than normal happens, almost triple. And then it shrank because of retirees. 65,000 people started leaving the workforce every day. That number was 50,000. So you have people leaving. The baby boomers were hanging them up and saying, "I'm going to go and let Kyle and David and gang manage my money and not have to worry about anything." And they took a pass. They walked out. Well, it used to be for everybody that left, we had a person, 1.8 people replace that person. Today, for the last 2 years, for every person that left, we only had a 0.8 replacement rate, which is the same as Europe. Very bad. Part of this is politics, that you haven't had a solid immigration policy since 2018. Now, I know we could look at immigration in the grand scape of things. My mom and dad are immigrants that came here legally in the 50s. Different ballgame. What you saw was during the pandemic, we shut off all immigration. And we should be bringing in 300,000 to 400,000 people a year, either permanent visa or work visa. Finally, to the credit of the administration, and I'm not a political guy. I don't play politics. I don't care. It means nothing to me. I got to make you all money based on what they do left or right. And I'm not picking sides here. But the administration has worked to get those visas back to where they were. And whoever's credit you want to give it to, I'll put that out. I don't know who owes the most credit to. But we are now back to where we're at 300,000 to 400,000 people coming in every year. So to answer your question, Kyle, the reason why you have a shortage is, one, retirees have left and you haven't anybody to put them in that spot. And the problem is with folks coming over the border, they're illegal, one. And two, they're not skilled workers. Immigration has to be a skilled worker set. And now that you have immigration back in check, you should start to get skilled worker sets again. But you're probably looking at the better part of 3 to 5 years to fix this problem. So what companies have done, even in spite of rising interest rates and a slowing U.S. economy, because we have slowed down, we were at, under the Trump administration, we had 6% GDP. Under the Biden administration, we went down to 3% GDP, and that's a lot of pandemic stuff in there. And now we're down to probably about a 1.5% GDP. That's because all that money that was put into the system is coming out. So the economy is slowing. And normally the economy is slow and higher interest rates. What do companies do? They lay people off because they want to protect their margins. Well, guess what they're doing this time around? Something that affected you. Rather than lay anybody off, they're just cutting their hours. So it's real simple. Look at where I make the least amount of money, 7:45 at night, 8 o'clock in the morning, lop off those hours, save those salaries. Don't lay anybody off. What we're seeing is the average hours worked per week has gone down from about 38 per week to 36. It's almost a full 2-hour move. That's significant. Think about 168 million people working in the workforce. You shorten their work week by about an hour and a half right now. That's a big number. So what it's doing is protecting margins, keeping the employee in their seat, not causing any layoffs. And suddenly you've got a different ballgame than we've ever had before. We've never seen this happen before. Generally, it's just easy. Lay some people off and then hire them back. But because of the shortage of workers, they don't want to let those people go because then they got to hire them back at a higher wage, or worse yet, not hire them at all. So that's the problem in the economy. I would argue the number one thing we're faced with, can we right this ship on demographics? And this year, it looks like we will begin to grow again. Here's a fun little story on demographics. I'll make this quick because it's demographics are so critical to what I do for a living. It's so impactful. Understanding population and population trends matter in economics. Who's a buyer? Who's slowing down? Who doesn't have enough people? Japan hasn't grown in 20 years. Why? Their population is shrinking. They've got more old people than they do young people. It means they can't generate enough tax revenue, pay for the old people. Boom, can't succeed. Who else is like that? Europe can't succeed. Exact same problem. They're shrinking. Guess who's about to shrink? Actually already started. China. China's well on their way to shrinking. And that means they're gonna have a bunch of old people, not enough young people to do it. And oddly enough, the younger people that live in China, especially those with degrees, guess where they're coming? United States. Why? Because they don't want to work in a factory, especially if they got an education. That's brilliant for us because now you got educated people coming in, working in high-skilled white-collar jobs. That's what you need. We are a white-collar country. We still have blue-collar. Manufacturing represents about 11% of the U.S. economy. 69% of it is services. And that means all types of services. So that's a big deal for us. So that means when you think about what trends matter, demographic trends are really very important. And ours, oddly enough, is as our boomer generation shrinks, as folks pass away, and that Gen Z millennial generation grows, which are the big buyers, we've got, oddly enough, a really cool demographic makeup where we have now more people in the middle and at the bottom of our demographics than we do have the older. It used to be the boomers represented the largest number of people in the country. Now they're just about a third of the three different groups. Call it, 16 to 40, 40 to 60, 60 and greater. That 60 and greater is now shrinking fast enough where that 16 to 30 is now the biggest generation. And what do? They buy, they work, they create revenue, they create taxes. So that means we have a demographic makeup that's wonderful. We can support our bills. We can support our older folks. Now, you don't want the bills to get any bigger than they are, by the way. That's a whole separate conversation about government debt. And it is an issue right now. But certainly we're much better off than all those countries I mentioned. So a long answer to your question, but demographics matter and we're in pretty good shape. And that's why ours has done so well.
The question that just came across is, what is your outlook for traditional downtown office space and reinvestments?
Great question. So if you look at the $1 trillion that's out there in commercial real estate and you break it down, where's the pain and suffering going to be? Only in one area. It would be office buildings in the A and the B city. So anybody that's got a lease that's out there 5 or 10 years or later, backed by a mortgage-backed bond, which is where there's concerns about default, is in trouble. That's an area where we'll see default. And what companies are going to have to do is say, I'll make a deal with you. We'll cut your rent in half and extend the term of your loan by 5 years so you don't walk away from the office space. And that means that bond behind it is not going to pay as much interest and probably won't ever mature at par. If it does, it's going to take an extra 5 years to get it. So you got to be really careful where you make your bet on real estate right now. Private equity is built for this. This is where all the hidden money in New York City and Chicago and LA come barreling in to buy what's called a distressed opportunity. It's because in New York City today, the occupancy is just about 55% during Monday, on Tuesday, Wednesday, and Thursday. It's really bad on Mondays and Fridays. Now the tourists are back, I can tell you that, and certainly the streets are crowded with them. But people in the buildings, nowhere near where we were. Hell, I can get a reservation at just about any restaurant in New York City now and not have to wait, which is not the way it was pre-pandemic. There's just less people here. So the answer to your question is, there's pressure in that space, so you got to make your bets smartly. What you want to have happen is let the old noise about, oh my gosh, there's lots of issues in real estate, and you let that market sell off, and then you pounce. Where? Student housing, never an issue in student housing. Kids go back every year and pay a big rent. Multifamily, same kind of thing. Non-office buildings, same kind of thing. Industrial, meaning Amazon facilities, that's a great place to play the REIT market. So if you're going to make a REIT bet, I would do it either after I'd go into that distressed debt after the correction that's to come. Where's that correction going to be felt? In the regional banks. Those are the ones that hold about a third of that paper. And then beyond that, when you think about who is going to really benefit, the folks who are willing to pounce on those markets or not be in those markets. And that tends to be private equity or the really savvy investor.
All right. Saw another question come in. What do you think will happen with the spot prices of precious metals, gold and I just went blank on AG. Golly.
So gold being always an interesting topic. When we grew up, gold was this really cool place to go and make a bet against inflation. And they did it because it was a limited supply of gold. And it was, in essence, it was the pre-cryptocurrency era. That, you know, if you wanted something alternative to the dollar, where would you go? And in fairness, if you look at gold during this, you know, call it this pandemic, pre-pandemic gold was trading, I look at GLD as a proxy, which is a ETF that reflects the price of gold. In April of 2022, gold was trading at $184 a share for that ETF. It hit a peak when inflation was really a concern early in this year at 187. So I mean, it did correct during the pandemic all the way down to 153. So you went from 184 all the way down to 153, back up to 187. Now you're trading 179. That chart makes no sense. If gold was still an inflation hedge, it would be straight up. It would have gone straight up because we know we've been dealing with inflation since about 2022. And what happened is gold has become much easier to trade and much easier to speculate in. So my concern about gold is that it trades in this range and it's no longer a natural hedge to inflation because it now trades like a stock. Back when you used to buy the bullion and keep it in your safe and it was a limited supply, it was much more of an inflationary hedge. Today, it doesn't reflect that. And it's because there's so many speculators in the price of gold. So it's once natural hedge is gone, because there's so much trading in it. And the same thing for oil and the same thing for most precious metals. But I would say, if you want to play the minimum markets on demand, I like the lithium market. The lithium market is only on the precipice of how much demand there's going to be. And there's ways you can play precious metals in certain ETFs. Now, it's going to be volatile. But you think about where and how much lithium we're going to need in the world with this explosion in battery operated cars or electric vehicles, you know, this EU revolution that is to come. I'd much rather see you play an alternative source of return in something that's rare earth minerals rather than trying to use gold as a hedge, because I just don't think it works as well as it used to. Had a pretty good year last year, down a bunch this year. And if I'm right about inflation and inflation is going to keep coming down, then it's going to be a great place to be. Where gold would make some sense again is if we start to see real defaults in government paper. Let's say somebody like a Japan backs away from their debt, or that's too big of a country. Let's say a Venezuela, and there's contagion about a Venezuela or an Argentina or Brazil. Brazil default on so much government paper because it can't pay the price of inflation. And gold might be interesting again. We're just not in that scenario yet.
Okay, so I think that kind of answered that other question. Gold is physical or gold is ETF. That kind of both.
ETF.
Yeah.
And
now,
buying the physical bullion is much harder than it's ever been. Finding a bank that'll hold it for you, buy it, and then you pay a transaction. But it used to be simple. You didn't pay these whopping transaction fees. You didn't pay these custody fees. You didn't pay the security fee. So it's not just buying the price of the bullion, it's all the stuff that goes along with it. And then being able to trade it. Well, they trade it for you. Find an institution that'll do that's a little bit harder. That's why the ETF is so popular. You can buy it today and sell it tomorrow. So I'd say right now it's sold off a bit. Okay, it's an interesting play. I wouldn't buy it yet. I'd say if you see it sell off significantly, because inflation comes way down. So for example, let's say inflation breaks 3% in the next 12 months. You're going to see GLD trade down probably about 172 to 165. You see a 165, 172 trade, that's probably a buy. Yeah, it should trade. The average price of gold should trade somewhere around, 175 on a high end. And we did see a low of 153 last year. Anything sub 160, I think would make a nice trade. I don't buy it. I don't like the volatility and speculation in it. I like to buy commodities when there's high demand for commodities, and there's not high demand for commodities right now. You see China shrinking, not growing. Europe's hanging in there more in services than demand. So we're not in a commodities bull market yet. That'll happen once this fear of global recession, US recession is over. Once we get to all the pandemic money spent, once all the interest rate increases out of federal banks are gone and out of the way, and inflation normalizes, then we get another real bull market. This one to me is not a real bull market just yet. Not in commodities, at least.
So I think both of these questions can be kind of answered briefly, because the first one is oil has trended up recently. Will it continue? And then the second one is many countries are moving back to nuclear. Is uranium investable? And when I read that, all I could think of, I had a flashback to Back to the Future and saying, yes, it's investable in Libya. But anyhow, only Doc can do that. But anyhow, oil, what do you think? Still an upward trend for the remainder of this year?
I'm gonna sound like I'm a political pundit for Joe Biden right here. He's probably gonna throw something on my screen if you live in Texas. I am not a political guy. I do not fight that political. I don't care. I really don't care. But again, credit the administration and the oil companies that came to a grand bargain. We are on the precipice of producing more oil this year than we've ever produced before. We're going to close in on that $14 million a day per barrel scenario. Where OPEC tried its best to put real pressure on the oil markets by cutting back. Russia agreed with them. The United States said, okay, go right ahead, and it increased production. So did North Africa. So did Nigeria in Africa. So did the southern countries. So guess what? In spite of the war in Russia, Ukraine, and now in fairness, Russia's still selling oil to India and to China at below market prices. So that oil, their oil is still on the markets. But the United States stepped it up in natural gas production for Europe and now in oil. If you don't believe me, just this past weekend, there's a wonderful article in the Wall Street Journal about this with the volumes per day, and I could gladly show it to you if you're interested in. I'm not making this up. It's the facts. I know people love to fight this narrative. So my point is, oil is a very speculative commodity. It's demand-based. Hot summers and cold winters drive it higher. Then you've got geopolitics, war, Russia, Ukraine. Then you've got oil coming from all over the world. And who's going to be the supplier? I like oil when we're in an expanding global situation, and I don't like oil when it's contracting. Right now, the world is slowing down. It's not expanding. And we've had, I mean, from what I can tell, there's certain parts of the world that have had very hot summers. Some have not. I live in New Jersey. We've had a very cool summer up until recently. So it hasn't been a global demand. Now, I know we hit the highest daily record of heat ever a couple of days ago. So I guess it's somewhat myopic to look at it from my point of view and where I live. But certainly when you think about where the rest of the world is and how much demand, right now we're more than meeting the demand and there's not excess demand. There is my black swan for a recession is not inflation. It's not the federal government, not even wars. It's oil. If for some reason there was a real demand for oil and oil pushed back to $105, $110 a barrel, all bets are off. The whole world's going to fall into a nasty recession. That's the only way you're going to fix that. But that's not the case right now. Demand is meeting supply. Green energy is coming online, not to the degree anyone thought, but it's there. And then nuclear has stepped it up. And the real winner, natural gas. And natural gas is a lot of it. You can't make any money on it. Still trading at $2.50, $3 a BTU, but it's been the energy source of du jour because it's so easy to move around and use. And by the way, your question on nuclear, it's a fallacy. It's a fantasy. In the end, it's the most green technology we have. But the cost of building nuclear power plants and the regulation you have to go through, just think, for the first time in 33 years, the United States is about to open up a nuclear power plant in the state of Georgia. 33 years, one plant. We've shut down a whole bunch of plants in that time frame. We just don't seem to have the appetite for it yet. It's far and away the most green thing we have. What might change that narrative domestically and globally, so I wouldn't buy uranium yet, what might change it is this new cool technology called green hydrogen. I think green hydrogen is one cool thing. It's you just take regular old water, you split it, and you take the hydrogen out of the water, and that's what you power a plant with. Very clean, very green, very efficient. Moving hydrogen through pipes is a problem. You got to have very strong pipes. It's more intense than natural gas. But the only way you get green hydrogen is if you power it with a wind turbine, which we know isn't great. Those wind turbines are only so good. There's a lot of issues with them. But it's the right way to do it with a nuclear power plant. And you're starting to see some countries, France, the Nordic countries, and a bit in the US, we're actually way ahead in our technology to create green energy. But someone's got to power the plant that can split the water, and that power should come from nuclear. So I would think that there's a chance we'll actually build a few nuclear power plants in the next 5 years. But boy, that's a long shot. So the answer to your uranium question, I wouldn't buy it. I mean, it's a great, in theory, it's the right answer. Politics and passion will get in the way of the right answer. Imagine there's never been a nuclear disaster anywhere in the world other than Russia. Fukushima worked out just fine. Right now, as of now, there's been no issues with Fukushima. The fail-safes worked. The plant did have a nuclear disaster, but it never affected the environment. 3 Mile Island, we were kids. There was never a nuclear. There was some steam that got released, but the canopy around it protected us. Never had an issue with that. The only place there was an issue was Russia. Why? Because Russia didn't have this big, that big cement dome that sits over a nuclear power plant when you drive by. That's there for 2 reasons. One, because when a plane flies into it, it would protect it. And 2, it protects it from a release. Well, Russia didn't think they needed it. So Chernobyl happened because they didn't put the fail-safe in place. There's never really been a nuclear disaster anywhere in the world other than Russia. France and Germany today Germany's trying to back off it, and then Merkel got kicked out, and the new guys think he wants to turn them back on. But in Germany, they're still nuclear dependent, and so is France.
So, and the question just came in, isn't Japan heavily invested in hydrogen power? I'm not.
Yes, green hydrogen, no. Hydrogen, yes, green hydrogen, no. 2 different things. You can get hydrogen out of gas. You can refine it from oil, but that's dirty. Dirty hydrogen, nobody wants. They want green hydrogen.
So let me go to this other one. Now this is going to be kind of a stretch, I think, for you, Phil, on this one.
Oh, by the way, there's an add-on to that. Sorry. Containment dome. What was that thing? I didn't know.
Yeah. He Thomas said containment dome.
I didn't know that.
Yeah.
The one Japan is trying to go to green, but they had a nuclear issue, right? So now where do they get the green power from? But they are, and we are the 2 leading countries in developing green hydrogen, but you got to find the power to do it.
Okay. So for a retiree with MIGAs at about 5%, what would you be the maximum turn you would recommend to lock in a contract if we consider that inflation could be closer to pre-pandemic around the next 18 months? Thanks.
That's an easy answer. Lock in right now. These are the best yields you've seen in decades.
But for how long? Do you do short term?
No, you do a
long
10-year deal. You're not going to see rates this high for long. Maybe another 6 months, and you're going to see them come down and down and down. Take it. We talked about this last time. Please take advantage of higher yields for the first time in a decade that you can lock in, and you could care less what happens in the world. Go ahead. If you want to just go buy municipal bonds, you don't want to pay interest, you can do it that way. Go buy 10-year munis earning 4% pre-tax, which is effective tax yield of 6% because you don't pay federal, local, or state tax on them. Get your municipal bond interest and go sit on a beach or fly in a plane and could care less about these mind-boring conversations. Stop here. Stop listening to me yap. It's a waste of time. Excuse me. Go and buy your municipal bonds and go, oh my God, I finally can make some money and not have to worry about it. It's a free lunch. Don't take advantage of it. If you want to buy an annuity because you want step-ups, go crazy. I mean, and the money's locked up. You can always sell a muni bond. I mean, Kyle knows this stuff better than I do when it comes to
well, and
You're going to put yourself out of business, Phil.
That's okay. If you're out of business because you did the right thing, good. If I'm out of business, that's
well,
okay.
the whole thing is, and that's what he's saying. And that's what David's having technology problems over his office, so he had to pop in. But Lindsay, David, and I have been telling everybody that if you have that extra cash and you're looking for that safeguard, we're not going to. I mean, we can look and see what interest rates are showing to be predicting in the future. Now's the time because, like Phil said, we might see 2 more rate hikes. And then what ends up happening is then they start bringing those rates back down. We're not going to see that. So anyhow, any comments on CBDC?
I may sound like an idiot here, but what is a CBD?
Okay, are we talking about CBDs? Or what?
Or, business development, BDIC.
Help me out, Joe.
There are some currencies out there, if that's what they're referring to.
Central bank digital currency. Okay.
Yes.
I was thinking medical marijuana.
I got you, Joe. I understand. Yeah, forgive me. It's not something I spend a lot of time on because it's a bit of a unicorn. I don't think it's happening anytime soon. But in fairness, let's follow that thread. Let's think about this. If I'm head of the IRS and I'm plugged into the administration, any administration, doesn't matter which one, and I go, let me think, what's the number one way I could eliminate tax evasion and tax fraud? Well, eliminate all cash currency, eliminate all dollars in the system, make it all digital. Here's why. You can't cheat the federal government out of taxes if they can track every single transaction. The reason why the IRS wanted to hire so many people was because if you don't have a cash transaction and you're going to put a roof on your house and can't pay the local contractor in cash to avoid the tax, well, guess what happens? Every single transaction is tracked, taxed, and going further, if you're in a communist or socialist country that has real strict draconian laws and you end up in jail, they can immediately take your money away or give it back to you. Imagine the federal government can determine what your tax bill is, and then you just take the money out of your own bank account without even filing a return. That's where AI and technology takes you. So I think it's really scary from a privacy standpoint that a CBDC, I just call them digital, I call them digital treasury. But anyway, you're right, that's the right nomenclature. So I think it's really scary. I think it gives unwielding power to any government that wants to do it. By the way, China is well down this path. That's why there are people that want to leave that country. And in the United States, I think it would be really hard to get through because it's a privacy issue. But I will tell you that I can't imagine there's not a, what federal government wouldn't love it if every transaction, one, they could stop printing money to save money. Two, they can track every transaction. They can eliminate fraud and they can control you from if you get yourself in trouble with some sort of criminal activity. I would guess that somewhere this is coming. And it's not here yet. And I would hope we fight the good fight on that because you lose all your privacy, but somewhere it's coming. By the way, think about how much stuff you do digitally already. How many of you use your online bank account to pay a bill rather than send a check? How many of you use Venmo or PayPal or Zelle? You're already doing it. And that's the millennial generation could care less. My daughters don't carry cash as their life dependent on them. You guys gotta use your cash. When you go to the gas pump in New Jersey, we have two different prices. Pay in cash. Nah, everything's on like that's a game changer. No, it doesn't play in the portfolio management or anything else we're talking about, but it is fun to talk about.
Any other questions out there? Okay. So let me wrap this up because this is the question that sits here on everybody's mind. And, is it possible, and sorry for the question coming from a retiree question, but what is your point of view of MYGA 10-year versus FIA, fixed index annuity, or a combination? By the way, I'm booking a visit to your office, to the office. So,
I would do a combination. It's always because, and Kyle knows this better than me, so I'm going to speak out of turn here. With that fixed annuity, I don't know if you ever need liquidity. I'm going to assume it's pretty hard to get that. You can pay some penalties, and it's fairly locked up. So if you do a combination of both, you have one that's going to give you the same yields. The annuity might give you a step up, but the same yields, and you have some liquidity if you need it. So, to my opinion, but Kyle, you know this space better than me as far as when to use annuity versus a bond portfolio or combination thereof.
Actually, sorry, I was looking aside. Repeat the question, or Lindsay, you nailed that one.
This is your
Yeah.
fault. You're supposed to pay attention, for gosh sake.
No,
Oh,
Candace
what
is
the hell?
sending me a
I
message.
say we don't make fun of them now.
Yeah. Lindsay, you respond to that one. Actually, Lindsay is really the resident when it comes to MYGA FIA. Whenever I have questions, I ask her.
Mhm.
Lindsay, fire.
Yeah, and coming from the banking world, annuities were something that we used a lot in our business, just because most of the clients that I dealt with at the bank were very conservative. So therefore, we were looking at alternatives that were more conservative than they wanted, principal protection and that sort of thing. So but yes, I would definitely agree that you need a combination of both, and you need some that is not in the annuity realm too, so that we have liquid money too. So, so a little bit of everything, stay diversified. So yeah.
Agreed.
So when
Mhm.
people think that Candace runs the office, she does. She's sending me instruction while you're speaking. So my apologies. Candace,
I wasn't
me
going to
what
miss
to
the
do.
opportunity to bust your chops. I mean, come on, there's no way I was going to miss that.
Candace is my Joey. Okay. And that's Phil's right-hand woman. Okay. So I want to wrap this up. I really do appreciate this, Phil. But first off, to take us out, you can just send us a message if you want to get signed up for Phil's weekly commentary. He has a podcast, great podcast. We always get notified when it's coming out. The one that dropped yesterday. But let us know if you want to receive his weekly podcast. And also he does other calls like this. One's coming up. And so just to let y'all know, there is more times that you can visit and hear from Phil than just this. But Phil, I think every person's main question is looking at their account, because this is what it's all about, is that's the money that matters to them. We're looking at mainly portfolios, well-diversified portfolios, whether they're managed through Ladenburg or they're managed through else places. We're looking at portfolios that are conservative, moderately aggressive. So if we're looking at those managed portfolios for the rest of this year, what is that looking like? Are we expecting minimal growth, some growth, or is the Magnificent Seven or the top 20 going to carry us into 2024?
We're already seeing a bit of a seat change there, that we're seeing the Magnificent Seven cool off a bit, go down a bit, and some of the other names are picking up a bit. I think the bond market is going to be much more lucrative than the equity market for us this year. We've had one heck of a run in equities. You might get some rebalancing in equities. The Magnificent Seven come down a bit, the rest of them go up a bit to keep us about flat. I wouldn't expect a lot more of the equity market. It's not inexpensive. The stock market is not cheap right now. So to me, we're either at or near all-time highs. In fact, I would expect us to sell off a bit and then get it back before the year's over, end up about here. My expectation for this year was 15%, and we're at 15%. Sorry, folks. This is, by the way, getting right now we're up 9% in the average balance account. That's a doggone good number. So as long as we can, I'm almost tempted to add products that lock us into that return, because it's a great number. That's exceeds our average annual return. And I know you'd like to get 30, but doing a 9% at this point is a pretty doggone good number. The bond market should go a bit higher. As interest rates go down, prices go up. So I could see us making a little bit of money there. At the end of the year, maybe a bit higher. But this is important. This is not a straight line between here and there. I think we're going to have a really tough August and a very tough September. So for that, I think it's really important that you understand this has been a heck of a rally because a handful of stocks, the bond market's not up on the years, up 1%. And we are, as things cool off a little bit and we get into some version of a recession, which probably isn't until early next year anyway, it could get real bumpy between here. But the market anticipates this stuff 6 months out. So the Federal Reserve is probably going to hike rates 2 more times. Inflation's not out of the way. So we're stuck in a scenario where volatility should pick up, and it should pick up pretty profoundly. Remember, the worst month of the year is September. The turnaround month is October. Some of the best months are November and December. But we're about to go into an election year. Brings in a whole other set of variables and volatility. So be happy we are where we are. I wouldn't expect much more than this. Sorry, I don't mean to burst the bubble, but that's the honest truth.
That's absolutely fantastic. I really do appreciate it. And yes, this is being recorded. So if you would like a copy of this, listen back through it. We'll be more than happy to send it out. We're going to be posting it on our YouTube channel so that people can go out there and check this out. But Phil, thank you so much. And hey, and congratulations. I understand more money is going to Georgia.
That's correct.
Georgia. Yes. His other daughter got accepted into UG.
UGA, yeah. So they're both University of Georgia students now.
There you go. Welcome to the SEC.
Yes, SEC. 2 flights now I have to deal with, but that's okay.
Anyhow, y'all have